Can you just give us a broad overview of how that's likely to change now compared to the last time you issued a forecast like this?
Thanks so much. And we'll have that updated tenure outlook later in the spring, so sometime before the end of the spring, which is June 20th. The early indications for 2024 are that outlays are rising by more than we expected in our February 2024 update. And we see that in a variety of ways. One is outlays for student loans and for SBA loans. Those are credit re-estimates that the administration has said that the instance of the money coming in for student loans and the money coming in for SBA loans is going to be less than they had booked in the budget before. So that will increase the deficit. There's a security supplemental of $95 billion. That's new legislation since our February update. That will also mean an increased deficit. So there's a variety of other things, many of those pointing in the direction of a wider deficit.
Well, of course, when we think about deficit reduction, there's kind of two things that factor in. One, you could spend less. The other, you could raise revenue. Obviously, all of that has difficulties, especially in that spending less. In large part, there's only so much you can do in terms of spending cuts when you have mandatory spending like Social Security and Medicare. Is it easier for lawmakers to act now on those issues rather than waiting for it and potentially exacerbating the deficit in the interim period?
Yeah, it is one of the challenges of looking at the deficit is that we know that the current situation is not sustainable, but we don't know when that moment will come, when in some sense will markets lose faith in the willingness of the United States to take on the job of deficit reduction. And so acting sooner makes it easier in a sense that the changes, whether on the spending side or on the revenue side, those changes are smaller the sooner that we act. But as you said, it's difficult at any one moment to act.
Well, something else that makes fiscal sustainability more difficult is the cost of borrowing, right? When we are now here at Bloomberg talking each and every day about this idea that interest rates may stay higher for longer, how do you think about that in terms of the fiscal outlook? What are the implications of that?
There's an important implication of rising debt on interest costs. Now, net interest outlays for the U.S. government this year are already set to be more than defense spending, and soon they'll be more than non-defense spending. This is the discretionary spending. So net interest outlays have risen and are becoming important. As our debt gets larger, well, that means that we're more vulnerable to higher interest rates. And so as an example, if interest rates are 50 basis points higher than we had in our budgetary projections, well, net interest outlays will be about $2 trillion higher over 10 years. So it's an increasing and important vulnerability.
Well, and there also is kind of this circular effect here, right, where you have to consider that higher interest rates are a product of higher inflation, but there's an argument that the deficit can cause inflation, that fiscal spending as a whole can be inflationary. How do you think about that kind of feedback loop?
No, it's an important feedback, and in some sense, it means that the U.S. is yet more vulnerable. So if higher deficits feed into higher inflation, as they clearly did over the past several years, well, then that means higher interest rates and more net interest outlays. Now, inflation has come down over where it was, say, 2 years ago. There's been an uptick of inflation early this year, but we still expect inflation to moderate through the rest of this year and then into next year. The challenge is the pace at which that happens, the impact on interest rates, and then how those changes interact with our debt.
Yeah, and who knows what will be on interest rate levels or inflation levels by next year, 2025. Something else I wanted to ask you about 2025 is, of course, that is when we're going to have to be dealing with the tax cut question that was passed during the Trump administration back in 2017. In 2025 is when they expire. How much would it cost if Congress were to renew that at a time when we're talking here about high deficits? And again, this would be less revenue coming in.
No, that's right. That important parts of the 2017 Tax Act expire at the end of next year, at the end of 2025. Those are not in our fiscal projections in the sense of, the taxes revert to the pre-December 2017 law and there's more revenue. So extending the parts of the Tax Act that expire would cost upwards of $3 trillion over 10 years and really closer to $4 trillion, including the interest service.
Okay, so when we were considering this back in 2017, the CBO did find that the economic benefits of that legislation wouldn't outweigh the costs of the higher deficit. So they didn't pay for themselves. Given how much has changed in the interim period, though, that was 2017. We're here 7 and 8 years later. Have you changed the way you might think about the economic value of lower taxes?
It's something that we look at all the time, and we revisit our analysis of the 2017 Tax Act. Back in April 2018, CBO put out analysis saying that the 2017 Tax Act had a positive impact on business investment, and from there to economic growth and job creation. And we saw that in the beginning of 2018. The challenge is that in the middle of 2018, there's a slew of tariffs and other trade actions.
Right.
Then in some sense had a negative effect on business investment. So that's the sort of analysis we would do again with whatever Congress is considering, extending some or all of the tax cuts or none of them. We would look at those impacts on the economy and then on the budget.